people might not know is areas regarding provision and accrual. I was trying to explain that on my Twitter recently too. People do not really understand that there's a difference between provision and accrual. Generally, when you hear provision in tax, any provision that you make, provision for bad debt, provision for something, provision for this, that is your P&L, automatically disallowed. Using some nomenclatures like payout to police officer, payout to the chairman, local government chairman. Some people will put it on money left fee. Some people will put it. All those kind of nomenclature that you use, and you will see the amount that is huge, they automatically attract disallowability of that expenses. Although the tax authority would have, the tax consultant should have done that by disallowing it in the income tax computation. But I think you also need to, as an individual, because we have a wide number of people, we have about 200 people on this call. So I think this might also benefit you. Using the right nomenclature can save you additional taxes too. So make sure you use the right nomenclature. Then also another pitfall that people also look at that they miss out is that they're remitting taxes to the wrong authorities. The first time I was going to manage tax that was in 2017, I was going to file the VAT and go and file withholding tax on director's fee. I've forgotten completely. I've already almost went to file it with FIRS, only for me to remember that, oh, it's LIRS. So if you have done that and you meant to pay to FIRS, trust me, your money has gone. Nothing like you can collect it back. And you cannot say because you have paid to any other authority, you now justify it to LIRS that I've paid to FIRS mistakenly. That's not allowable. So that's the kind of error too that people make. Then finally, I'll talk about for big companies into manufacturing sector, or let me say people that are into production sector, we have what we call the input and VAT, input VAT and output VAT. It's another areas that you need to work like seriously on so that you don't have issues subsequently in the tax audit.
All right, thank you, Richard and Fred. The next question is mostly around how accountants in their role can make the work of the tax auditors and tax consultants easier. But it looks like most of what you have said touched it, but if we square in on it to discuss more specifically, it's not a bad idea as well. So are there tips you can give accountants on ground to make the work of the tax auditor easier and the work of the tax consultants easier? Maybe aside documentation, looks like documentation is one top thing. If any other thing, please share with us, sirs.
Okay, let me allow Frederick to go first.
Yes, so we said documentation, but another thing that you need to support your consultants with is timeliness. So a lot of times, the in-house accountant does not even understand how time is of key essence in the tax audit process. So the audit is time-bound. Once the audit commences and you get an audit report, everything has a time period to respond to. So you also need to have, as an accountant, you have to have that understanding that when your tax consultant requests for certain documents, for certain schedules, for certain information or clarification, you need to respond timely. Because when a delayed response outside the required time of response is actually no response. So if I have 30 days to respond to an audit and you are providing the documents to support a justification after 30 days, then you have put the tax consultant in a very difficult situation, because now he first has to beg and is at the instance of the FIRS to now agree to his plea before he can now tender the support documents. So timeliness is one key area. Documentation, like we mentioned earlier, and also during the audit phase, building that relationship with the FIRS, because like I said, the audit is a process. There are steps to it. You will need to have a good relationship when they are in their office. You don't have to respond to all the questions, but don't just leave them in the office. Don't offer water at the minimum. Say good morning at the minimum. Support the audit process. This helps the consultant because it's kind of reducing the work required for the consultants. So those are my 2 cents for now.
All right. Thanks, Fred. Sorry, I think I have some connection issues. But yeah, thanks a lot for that. Okay, so this is another question, right? And I'll push this to Richard. How can a professional handle situations where there's a discrepancy or error in the records found during an audit?
Okay. So I want to assume that it has been established that the discrepancy is the client's fault, right? If it's the tax authority's fault, it's usually easy. Frederick mentioned earlier that where in that instance of that woman that asked about 1 million naira and 1.5 million naira case, if you have checked all your records and you are very confident that everything we provided to FRS is correct, and you feel that the information they're giving you and you have more revenue than disclosed is not right, then you can authoritatively tell them to provide you their source, and they should provide you a breakdown of what make up that amount, right? So that one is easily solved. However, if the error is coming from the company side, the best thing is to do what we call internal discussion with the company, right? Ideally, let me give you for those are the tax on this call. Ideally, before you go for a tax audit, you should do a quick pre-audit check before you go for the tax audit. The purpose of this pre-audit check is to help you to discover areas that are likely to expose the company, and you will know how to manage when you get to that level. For example, I have a company that has they've disposed their, what's it called now? They disposed an asset that is significantly huge, and they forgot to pay VAT on the sales proceeds of that asset. They forgot to charge it, they forgot to pay it. Now, that asset, they've also, even though they've written it off in their books, that is, it has fully utilized its tax allowance, tax depreciation allowance, they've still continue to charge what's it called? Capital allowance, even though they've written it in the actual accounting book. They've continued to charge capital allowance because they were buying an additional asset of that category without separating it. Now, in that kind of case, it's quite complicated. The best thing you can do is to estimate the liability for the company and tell them to get ready to pay it if the FRS discover it, right? However, if the discrepancy is merely as a result of classification issues, for example, sometimes we have a GL called professional services, and we have another GL called accountancy services, and you have another GL called audit services. When you look at your audit invoice, you've paid 9 million naira for the year. Your audit GL is showing 4 million. Your trial balance is showing 4 million. TB and this thing, everything tied together. But your actual invoice is showing 9 million. You know there's a problem. So you now need to check, how did they post this invoice? Maybe they post it to another place and then reclassify it. There is a need for you to have a very solid reconciliation skills as a tax accountant or auditor. You need to have a very good reconciliation skills. And finally, to add to that is that where you've now discovered that this error is beyond what the FRS might likely not, or let's say LRS, what they will actually see because it is too obvious, then in that case, I think the best thing is for you to quickly agree on how to treat it, whether they would allow a part of it or disallow a part of it or whatever the situation might be, right? So that I will not overflow. And I don't want to also give any opinion now that people would find contradictory because of application, based on their business size, they might not be able to apply it. So I would just say, I'll stop there. Maybe if Frederick has another opinion around that, you can share also.
All right, no problem. So thanks for sharing that, right? The reality is a webinar, right? I'm sure if we take some sections of what we've, let's resolving error alone, we want to treat it as a topic on its own. I'm sure we can spend 4 hours talking about it, right? But thanks for that insight. Just have to also consider time management in the entire webinar, right? I think we have Olushola Ashafa. I think she has a question. So I'm going to unmute her to just basically ask the question. So Olushola, I know your hands are up. I guess you have a question.
Yeah. Good evening, everyone. Please let me know if you can hear me.
Sure, we can hear you.
Okay, thank you, Accounting Yard, for this webinar. Okay, so my question is, earlier this year, I got a letter from FIRS concerning audit. So Well, I just know it's audit. Today, I got clarity that that type of audit is like desk audit. So my question is that after the audit, they requested for documents, I provided, then eventually they called for a meeting. So I went for the physical audit. They asked questions and the likes. And at the end of the day, the person that conducted the audit or the questioning, he told me that that we are fine now. So they are supposed to write a letter, because they actually wrote a letter and sent it to the email of the clients that I represented. So it was like they are supposed to send a letter to like finalize everything, like saying that the company is fine. So my question now is, till date, the mail didn't come through, like the letter itself. They didn't send the letter, so we didn't go to pick it up or something, because we don't know whether there's a letter. So my question is that for subsequently, because they actually audited the company for 3 years, 2021 to 2023. So my question is, for subsequent years, what I mean by that is, let's say we are in 2026 and they now come again or send a letter now again requesting for audit, and they include some of those previous years. Is it okay for me to respond with a letter saying that these particular years have been audited prior to this time? However, because they didn't send in a letter saying they are fine with the audit, so I don't have an evidence to that effect. However, they've stopped sending email concerning the audit. So please, I would like our panelists to kindly respond from their wealth of experience. Thank you.
All right, that's quite interesting. So first of all, I'll just say you should try to lay your hands on the FIRS guideline on tax audit that was released in October 2022, right? It shows the superiority of one tax audit over the other. That is a desk review. If a desk review is ongoing at the moment, let's say the desk review covered 2017 to 2022. Ideally, a desk review does not cover much period, just like a current period, prior 2 years or 3 years. But let's assume that a desk review is going on for 2017 to 2022 accounts, and then they've not finished it. Then another letter comes that says tax audit for the same period. Automatically, wherever that one stops, you stop it completely. You cut it off from there. The audit supersedes the desk review. And where during the tax audit, an investigation letter comes, the investigation letter supersedes the tax audit. The only thing you now need to do, if you prefer one over the other, is to discuss with the FIR. Please let us conclude this one and close it. However, closing that, like you've said, closing that desk review does not mean they cannot still audit that period, because that one is just a desk review. And like I said, the tax audit supersedes a desk review. So what you should have done maybe next time is that you should tell them that, can we just make this a full tax audit so that they review everything once and for all, and then that is more sorted. That one, they cannot come back to that one again unless they want to do investigation. Now, the second part of the question that you've asked, which is you are waiting for the discharge, they call it a discharge letter. I don't know if there's any other name that they call it again, but it's called discharge letter. That means you are free from the audit. They've done their work and then they didn't find any liability, or maybe they found the liability and you have paid and you have settled it. That letter is only when you push and push and push that you get it. It's just like somebody trying to get money from you. I don't know, they did not say money to get from you. They're not telling them to write to you that they did not see any money to get from you. You understand that kind of thing? So you will likely not get that letter. They've discharged you, that one is fine. But if it's a tax audit, if I were you, if it's a proper tax audit, I will write to them the same way they've written to me to come and do the audit and they found nothing. I will write to them to give me that letter so that any other time they come back in the future, I can show them the letter that, see, this period has been audited. Do you understand? So I hope that answers your question. Hope anybody can hear me.
Yeah, sure, Richard, I can hear you.
Okay, just to be sure. Yeah.
So I kind of logged off earlier, and I know there are some questions in the chat box, right? So people, in case you have questions, you can reshare it in the chat box, because it kind of cleared the old messages, so I cannot see old messages again, right? And we would like to actually go through some of the questions that we asked in the chat box, so that we could also give people participation rights in terms of questions. So I encourage you, if you had questions that have not been answered, please reshare them, and I'll take my time to go through them. Yeah. All right. So someone said, can you give a small overview of tax operation for churches? LRS sent a demand notice to my church for WAT on professional services, which we didn't have records for. And we are obligated to them. And we also operate on a cash basis and no ledgers. So Fred, do you want to quickly touch on that?
Can you repeat the question again, please?
Okay, please, could you give a small overview for tax operation for churches? LRA sent a demand notice to my church for WAT on professional services and rent, which we don't have records for. Are we obligated to them? We also operate on cash basis and no ledgers.
Okay, so the request is withholding tax on professional service. So the question is,
so I think the person doesn't understand what are the tax application to church for tax for churches. Right?
yes. So the issue is you need to first find out whether or not you carried out that professional service. So where did the FRS get the information for that professional service? Did you really carry out the professional service? Now, the church, do they actually have a statement of affairs? In my understanding, most churches do not even keep those kind of proper accounting records. They just have collection and expenses and maybe bank records. So we try to encourage churches to still keep these details, because that a church doesn't mean you can't carry out certain businesses. You can still be carrying out some businesses that may require you that have tax and income tax implications. So you need to understand, I want to understand the actual structure of the church. We need to understand the structure of the church, then we give the right opinion on how best to handle it. So we need more information from this.
So in summary, what I hear you say is confirm that those services were rendered, right? Were there a professional service in question? Was there a rent in terms of in question? And the reality is they actually, if those services were enjoyed, they should to withholding tax and should have records actually pay or remit for that, for those instances, right? Yeah, and like you identified, a lot of them don't have proper accounting record. They should actually have some level of statement of affairs that shows the service, like proper accounts of what they've done as a church. Yeah, so another question that came forth was, please, how can a consultant go about the tax audit for a portfolio company that keeps only incomplete records? All they send for their financial statements to be prepared is their bank statements. So Richard, I don't know if you heard that question.
I'm not sure. I didn't get it.
Okay, please, how can a
I lost you a bit.
Okay, sorry, let me say it. I think I was muted. Please, how can a consultant go about a tax audit for a portfolio company that keeps only incomplete records? All they send for their financial statements to be prepared is their bank statements.
Okay, so I'll just assume that I did not see that person's name, right? But because according to the Financial Reporting Council of Nigeria, and then of course the financial reporting guideline that we all know, there is need to substantiate every information in your financial statement in supporting document. Approximately everything, even if it's an estimate, you need to show us the workings of where you got, how you arrive at that estimate. So I understand that you're preparing the account using the bank statement, fine. However, the position of the law, don't forget, the tax law is supreme when it comes to dealing with companies. Tax law in any country is supreme. So the tax law requires that you provide supporting document to justify the transactions you are undergoing with anybody, right? So I will encourage you that there's no way you can go about it, because what you have done is that you've used incomplete records, which many people do, especially small businesses, to prepare a full financial statement without having supporting documents, no GL, no anything to support what you have prepared. That is wrong. That is wrong. It's absolutely wrong. So what I would encourage you to do is that next time, try to get at least invoices. The company should create an invoice. They sold the item, they make the sales, they did the purchases. They should try to also get the invoices, even if it's not complete. They should get it. Then they should keep it. I'm telling you this because it saved one of my clients that could have paid about 300,000. It's small. It's a small company in Computer Village. The company would have paid a liability of approximately 300,000 naira because of just they don't have supporting documents. So luckily for them, they've been buying for the same customer, the same what's it called, the same vendor. Just went to the customer, please, this invoice, help me to write all the invoice. You are not forging it. You actually add that transaction with the company. It's obvious on your bank statements, right? Just make sure that you keep this documentation, and then that is the only way you can save the company during tax audit. If not, FRS can choose to see only the revenue and they did not see any expenses on the bank statement. I know you understand what I mean. Yeah.
Thanks, Richard. So I'll go to the next question. I think it's by Dara Singh. It's a long one. Company A and Company B, right, is in a strategic partnership arrangement to share revenue at an agreed percentage. Company A bids for these services and issues invoices to the clients with applicable VAT and withholding tax assessed accordingly. Company A sends the agreed percentage after all deductions to Company B, who is the technical partner. How will Company B recognize its revenue for tax purposes? As the same revenue has already been assessed to VAT and withholding tax with Company A. Fred, I don't know if I know this something looks like a question that falls within the oil and gas sector when they are providing service to those OICs.
Yes. So the first thing you have to look at is the contracting. When you say both are in a joint venture, what you explained is a joint venture arrangement. When you say you are in a joint venture arrangement, who enters the contract with the seller? Now, if it is both of us that are required to supply the activities to the seller, even if one person issues an invoice, the invoice should carry two separate accounts for payment. Even if one person collects the payment, both should, the other party should remit immediately. Now, for VAT, if both of us should enter the contract together, if it is one party that will pay the VAT, then we have to engage with the FRS that for the sake of this joint venture arrangement, this party will remit the VAT. This is how we choose to do it. For the sake of simplicity and to avoid any complexity, this party will be the one that will remit the VAT on behalf of the joint venture agreement. You have to have that special arrangement with the FRS. And it happens, yes, in the oil and gas, when we have to deal with NNPC and some gas arrangements. Then when there was VAT on gas. But you have to have it cleared up with the FRS, and it has to be clear in the contracting. If in the contracting it is just one party, then the seller is the person, the contractor, the seller in the contract will charge VAT and will remit the VAT. Now that you remit another payment to the other party, when that party is not part of the contract, then you have to define what that payment is. That's a separate arrangement. And you have to define whether that arrangement has a VAT embedded in it. In which case, I am facilitating a trade on behalf of this person. So it's an arrangement. It's a service I'm doing for that party. If you understand what I'm saying. So the contract in itself will drive the tax implication and the parties that will remit the taxes. So we need to understand what the contracting is. And if it's one party that is remitting VAT on behalf of the two joint venture partners, then you need to clarify that with FRS. If FRS does not allow one party to remit on behalf of both, then both of you will have to bear your costs separately. Thank you.
All right. Thanks a lot, Fred, for that. So there's another question again, and this goes to Richard. And so for a company that deals with many transactions in a year, though all the invoices are saved on the accounting software, but auditors need to see them, is it possible to check all the invoices, or there's supposed to be a minimum value for invoices requested for audits? So let me repeat the question, Richard. A company that deals with many transactions in a year, though all the invoices are saved on the accounting software, but auditors need to see them, is it possible to check all the invoices, or there's supposed to be a minimum value of invoices requested for audits?
Okay.
Basically, is there materiality in audits?
Yes. So I want to be sure that the person is referring to tax audits. So if the person is talking about tax audits, yes. So ideally, the law requires them to check samples, right? However, if it's a case of investigation, they can request for everything. But I would usually encourage you that, and that is why you need to build a good relationship with your auditor. Don't be hostile to them. Don't do as if they came to witch hunt you, right? So when you get to that stage of them requesting for documents, tell them these are the list of your major customers. They have your GL already. They have your sales ledger. These are the list of my major customers. I have 4 major customers that make up for 80% of the total sales that I make, for example. Please select top, let's say 50% invoices, let's say 3 or 5 invoices or 10 invoices or 20 invoices that make up the major bulk of transaction, and the small ones, let's ignore those ones. The FRS too, they want to do a work that makes sense to them. So just give them good supporting document that shows the bigger figures and they are good to go. However, sometimes they can just do, this also has to do with negotiation. Tell them, pick any of the invoices that you want. Don't pick 1,000 invoices because it's impossible for them to generate everything. Pick 20 or 50 that you want, and I will get my team to spool it out and send to you. So that's how you should work with the authority. Don't let them give you the stress of having to spool out everything, which can take several days, right? So both of you want to work efficiently, and I think you should be able to approach them. And I think one other thing I'll just add to this person's case, and many other person are asking similar question. Please try to be open when you are asking for your information. They are the one asking you for information. If you would think that information is not possible for you to give them everything, speak up and tell that, see, this thing is not possible. Sometimes if you scatter it for them, then they will become more serious with you. Sorry to FRS people on this call, but I'm sure that you guys know what I mean.
Yeah. Thanks, Richard, for that. So someone asked a question regards what evidence you provide for an inflow from a shareholder linked to loan. So I think that one is pretty straightforward. A shareholder loan agreement to suffice and properly signed by the company and the shareholder himself, right? That should suffice to the tax authority. So someone asks, please, what is the position of the law when a company failed to deduct withholding tax on a transaction liable to FRS? Okay. I think Fred, you can quickly answer this question. I just want to just breeze straight on. Yes.
Yeah, what's the provision of the law when you fail
to deduct withholding tax on the transaction?
Okay, so the new withholding tax regulation has made things better. When you fail to deduct withholding tax now, you have and you paid the person the full amount. So there are 2 separate cases now. I'm supposed to deduct. Did I deduct and not pay to FRS, which there's penalty with interest there? Or I didn't deduct, but I paid the person the full amount. That one just has an administrative penalty with one-time interest. I don't need to pay the amount that I withheld. I hope I'm clear. So let's say, let's say I'm meant to deduct 5% from the 10 naira I'm paying. I'm meant to deduct 5 naira from 100 naira. I'm meant to deduct 5 naira. And I deduct it, I didn't remit. Then I have a liability of that 5 naira, and I have penalty with interest on the 5 naira. When I now pay, if I had paid the entire 100, I forgot to deduct, then my penalty is less. I just have a one-time administrative penalty with interest. So that's the answer to the question. So the new withholding tax regulation has made it better than as it was before.
All right, thanks a lot. So let me go to people that raised their hands and let's get them to some questions. So let me just unmute Samuel. Hi, Samuel.
Hello, good evening, all.
Yeah,
Good
good
evening.
evening, Samuel.
Okay,
Good
yes, my question is, I would like to know what type of business should be charged withholding tax? Is it enterprise business? Of course, sometimes we deal with enterprise businesses. Other times we go to roadside to buy, which we also come back with invoices. And other times we deal with incorporated business. So what category of business should this withholding tax be charged to? I don't know if you get my question.
Yeah, I get a question. So Richard.
All right, so I think the answer is quite straightforward. The withholding tax is applicable on all transactions that has to do with supply, right? Supply and rendering of services. So withholding tax is applicable. And it doesn't matter whether you are a corporate entity or you are a business enterprise, or even if you are NGO. Now, the part of, if you are the one that asked the question about ecclesiastical organizations, like these churches and mosques, for example, earlier, and you are looking at how the withholding tax becomes applicable in the case of that professional services, the withholding tax becomes applicable because they are charging it on the person that provided professional services to them, not on the income that the church has derived. However, the law also provides that where the church or a religious body or society, maybe all these club and all those things, where they've derived income from other operating activities, not from the main operating activity, from other areas of the business that's actually a transaction, then that kind of transaction can also be subject to withholding tax, right? So withholding tax is applicable on approximately all transactions, taxable supplies, and services generally. So it's not about whether you are a small business or you are a, but maybe we can now talk about the part of the new withholding tax regulation that exempts company, basically, let's say small companies that have TIN. Let me put that also. Small companies that have TIN and earn below, let's say, approximately 2 million naira per month, they are exempted from withholding tax. I'm already talking futuristically because that becomes applicable from January, right? So for small companies that earn below 2 million naira per month, then they can be exempted from withholding tax or from charging withholding tax generally. However, you still need to understand, I think you need to pick up the withholding tax regulation. It's less than, I think, 7 pages or less than 11 pages. Pick it up. Maybe you can get it from one of the platforms on Accounting Yard. It's available online also. Try to look at it. It's very simple to understand. So I'll just encourage you to do that. But withholding tax is applicable on a lot of transactions, and you cannot just generalize and say that it's not applicable on this company or industry.
All right, thanks a lot. So let me unmute Hafiz. Hi, Hafiz.
Hi, Olade. Good afternoon, Mr. Richard. Good afternoon, the co-facilitator. Please, I just resume as a senior accountant at an internet facility company, internet service. So please, I want you to share more light in these two scenarios. Once invoice subscribers, MRC monthly, they we usually them invoices. Most of the revenue, according to IFRS 15, once you have not performed the obligation, you cannot recognize the revenue. So we need to prorate. I told them need to start prorating the revenue base if you roll over to other month. What about the VAT that involved? Do we prorate the VAT payable once this month? Now, today is 16. So part of the money is in December. Do we need to prorate the VAT too on that invoices, or we should leave it for that particular month and credit, we should pay it? So number two, the providers, the off-taker will take our internet service from. They charge us VAT. So normal as a law, where I'm coming from, oil and gas, we tell the VAT, we charge them, we tell the withholding, I will remit. But I was being told if you deduct it with them for the internet service, they will cut it off. So they'll prefer collecting it and go and remit by themselves. So I want you in also have an idea on this internet providers to share more light on this. Thank you very much, sir.
All right, thanks, Afis. But just before Richard or Fred answers this question, as much as possible, right? We are dealing with tax audit. So as much as possible, we want to ensure that we're restricting ourselves to questions relating to tax audit, right? I understand the fact that, yes, we want to share questions linked to tax because the reality is that we cannot answer all questions relating to taxes, right? But as much as possible, let's focus on questions relating to tax audit, right? And that's why the webinar is created. Otherwise, trust me, there's a lot of questions. There's people in the chat room raising their hands. We want to be able to, because we are almost at the hour, right? But Fred or Richard, I don't know if anyone wants to answer the question that Afis has put before the house.
Okay, maybe I should start with, so Afis, you first, I'll send you my account. You'll be able to credit me for tax advisory, right? So you credit me like 1 million for tax advisory. Anyways, like we've established, so one of the things you should take note of is that when you are dealing with, and I think this is why tax is very interesting. Tax is not stable. It changes every now and then. So in 2020, February 2020, when the Finance Act 2019 became implemented, there was a major issue and uproar around cash basis of accounting for VAT. And people were like, oh, this is the best thing that has happened in Nigeria and all those things like that. Now, where I'm going to cover the story short is that for the transaction, you don't need to prorate, even though it will look as if you are prorating it. But I'll just say on the receivables that you have actually, because before you recognize the transaction now, you either take it to your receivables, right? Then, of course, you recognize your sales and you still have your receivables. For the portion of that sales that you have received as cash in your bank, that is the one that you will make payment of withholding of VAT on. That is, you need to be able to filter. You do a kind of pivot that shows that this amount has been paid from total sales for this month. That is one you will filter. I can understand, and I think I can relate with you because I've worked with an IT company, a large-scale IT company that deals in that kind of industry you're working in. I've worked on that kind of project before. So you have to spool the entire sales for the month. I would prefer that you have a VAT code, depending on the sophistication of your ERP system. You can implement a particular code. If you are using something like SAP, you can implement a kind of code that says that V1 means VAT received. V1 means VAT receivable. So when you filter for it, you'll be able to know the portion that has been received by cash. And then you can now use that one to make your remittances. That's number one. Number two question that you ask is around dealing with MNCs, particularly oil and gas, for example. And then you give an instance of them saying that you cannot withhold your VAT or something like that. Yeah, based effectively from January 2023, the FRS regulation that was released in October 2022, yes, says that MNCs, even though oil and gas firms, MDAs, financial institutions, banks, they should all be withholding VAT effectively from January 2023. So probably that is what you experienced when you just joined this company. If you are dealing with those kind of companies, oil and gas companies, they will withhold VAT, they will deduct withholding tax on your invoice, they will charge NCD again. So at the end of the day, they've removed all the money that you're supposed to pay to the FRS and they will be the one paying on your behalf. You will just be receiving the money. It's just your own responsibility when you are doing your accounting for VAT to now include it as that withholding tax will tell that, and VAT will tell that source. Do you understand? I hope that clarifies.
Yeah, thanks. Thanks,
Yeah.
Richard. I
Yeah,
know. Yeah, you want to say something?
Yeah, just to add that the VAT is paying for the first point is the one that he has recognized as sales. In other words, the ones that he has performed the internet service for. So he will not remit based on those people that have, because of the kind of service, people pay for the service.
Okay, I get what you're saying.
It is once service is delivered that he remits the VAT. That is when there's
Yeah.
value added. Yeah, so you should
Yeah.
note that also.
Yeah,
Yeah.
I get it. So it's very important that reconciliation, collections against enjoy. So you may have collected more than what he has recognized. So you need to be able to do that reconciliation between collections and end, right? It's the end portion that he pays for. So then they will be most likely be carrying like let's say a
deferred income.
liability,
Yeah,
deferred income during the
yeah.
tax.
It will have a
Yeah.
deferred income, yes.
Exactly.
But
yeah,
it
yeah.
should not remit based on that, because for instance, if it's a kind of service where he has to return, he will return the entire money. But if he remits VAT before value added, he would have already
Yeah, I
paid
get it.
FRS free money. Yes.
Yeah,
So he
I
needs
get
to
it.
note that. Yes.
Yeah. So we're coming towards the end of the webinar. But just for those who are on this opportunity, we're organizing the Tax Practice Academy that covers a wide range of topics, from pay to withholding tax to VAT to current new updates in terms of the tax regulation that's basically been rolled out by the tax authority in the last 1 year, right? Covering also CIT and ET. And we're encouraging you to join, right? So this is starting 30th of November and will last for roughly about 3 weeks, right? And we have very robust facilitator that will be taking the training. And as you've joined this webinar, we have a special package for you, right? And this is very pocket friendly, right? So for example, the training is just for 3 weeks. We're just charging you a very discounted fee at roughly about 10,000 naira. But because you've joined the webinar, there's a discount, and we share that through the groups you joined, and you can reach out to us, and we'll share the discount link with you, right? And just take advantage of this, because this discount will be available for roughly about 72 hours, after which we'll not make it available again for those that participated during the course of the webinar. Yeah, but I understand that a lot of questions have been asked, but we're just about the hour, right? We don't want to overflow the time provided to us. So we use the last 10 minutes to conclude the webinar. Yeah. So closing questions to all panelists. So I'll allow Richard to start. And what is one piece of advice you'd give to young accounting professionals to ensure they are always ready for a tax audit? Simple piece that you want to pass on to them. So Richard?
The single one piece I would just advise you is to have your documentation in place and be on top of your game in terms of documentation. That's it. Once you have that part sorted, I think every other thing fall in place. Even your consultant will be happy to work with you.
Okay. So this is Fred. What are some of the final words of encouragement of tips for staying resilient through these challenges of a tax compliance? Fred?
Yes, thank you. So as accountants, we need to understand that tax audits are part of the tax system. It will always happen, but the knowledge of the fact that you know that it is going to happen is the first step to resolving every tax audit situation. Always have it on the back of your mind. For every transaction, for everything you are doing, for every line, there is always a tax implication. So if you have that in mind and you always prepare for the audit, if I'm posting this invoice, if I'm making this payment, what is the tax implication? Am I ready if FRS should ask me any question regarding this? Then once we have that in mind and create that mindset of proper tax, tax consideration and tax awareness in us, then we are fine. So as accountants, you also need to help your fellow tax manager, your tax accountant, and your tax consultant by having that tax mindset in whatever accounting entry or posting or accounting transaction you do. Always think of the tax implication. Once you have that in mind and you prepare effective for it, documentation, remittances, and you do everything the way you should do it, then you should be fine. Do not be bothered about an audit, but always know that an audit will always take place. And everything you do, you should put in mind that you have to answer for it during an audit. Thank you.
All right, thanks. Thanks a lot, Fred, for that also. So to be very honest, I know there are a lot of questions and we've not answered all of them, right? And it just makes it come to mind that maybe we need a part 2 of this webinar, right? And we realize that there are a lot of questions because we can see clearly that people are actually having challenges in terms of dealing with taxes and audit, right? But we're more than bearing this in mind. I'm sure we'll create another session where we get interesting minds like Fred and Richard to come and basically attend to questions such as this, right? Because I'm sure even them, they're quite engaged by the questions that are coming. Yeah, I'm just seeing questions all over the place. People raising their hands to questions coming through the chat box. I'm sorry we've not been able to attend to all questions, but we're not undermining the quality of the questions being asked. We're just trying to ensure that we're just working with the time that we've agreed with you initially, right? But bear in mind, we most likely create another session where we discuss more on questions asked, right? So this brings us to the end of the webinar. We want to use this opportunity to say thank you to everybody, right? Thank you for your time. Thank you for being available, making all your time. For those who missed some of the sessions, this will be available on the YouTube channel, so you can watch. For those who are looking to improve their knowledge of taxes and keep me updated, we encourage you to join our training starting 30th of November. And yeah, that will last for roughly 3 weeks. So a lot of the questions you're asking can potentially be answered, right? And we encourage you all to join. Thank you once more, everyone. Thank you, Richard, and thank you, Fred. I know it's not an easy